Hello and welcome to CMC Markets Weekly Trading Outlook for July the 27th, 2015. My name is Colin Szynski, Chief Market Strategist. There's three major things that I'd like to preview for this week's trading. First of all is the US FOMC meeting. Second of all is GDP reports for a number of countries around the world. And finally, I'll take a discussion as well about previewing some of the key earnings reports for the week ahead. Coming out of the week of the 20th, where the big action has been in gold, where we've had a massive sell-off. We're seeing that some of the stock markets around the world have also started to drift back lower as we move through earnings season. We'll recall that for the most part, for most of this year, U.S. stock markets in particular have been range-bound. The big relief rally we had following the Greek deal was lifted markets up, many of them up towards the high end of their trading ranges. We're now seeing them come back down. It's not unusual seasonally to get a rally in July heading into the first part of earnings season. However, it's also important to remember that we're now heading into the weakest time of the year seasonally for stocks between August and the middle of October. This starts as earnings season winds down and people reconsider what could happen for the rest of the year. So we are heading into a seasonally weaker phase of the year for stocks. Initially, however, I'm going to start off with a focus on the U.S. dollar and currencies. And I've brought up the U.S. dollar index here just to highlight the strength we've seen in the dollar over the last couple of weeks. It's generally been rising, and we've seen it other things coming off. The primary reason for strength in the U.S. dollar is that as we started to get a number of the headwinds fading away from the Fed's interest rate liftoff program, they had talked concerns about stock market and economic turmoil in China, turmoil in Europe, and other areas that those have started to fade a little bit, clearing the path for the Fed to start raising interest rates, perhaps as early as September. This week we get a Fed meeting. The Fed is not expected really by anybody to do anything, but the key focus will be on the statement. In the statement, people will be watching to see, does the Fed hint towards a September rate hike in any meaningful way? Or on the other hand, which could be the bigger surprise, do they go dovish and perhaps make suggestions that interest rate liftoff could be farther off? The big massive rally we've had in U.S. dollar over the last few weeks now has pretty much priced in the possibility of a September rate hike. And the reason I say that is because recently we got the lowest U.S. jobless claims in over 40 years. It was actually since the fall of 1973, and that's hugely good news for the U.S. job market and the U.S. economy. And yet the stock market didn't do anything on it. The U.S. dollar didn't go up on it. And what that said to me was that this just yes, it piles more evidence onto the case for raising interest rates this year, but that interest rate increases have already been baked in. So when markets fail to respond, when rising markets fail to respond to good news anymore, it suggests exhaustion. It suggests everything's already been priced in. And that's what we're starting to see here in the U.S. dollar. And interestingly enough, over the course of the week ending, it's actually started to come back off a little bit. This suggests to me, as I said, that there is a potential, if we do get a surprise that could move the markets, it could be a surprise to the dovish side. So we'll keep an eye out on that. The U.S. Fed isn't the only major news of the week. I'll just do a quick preview here. Monday's pretty quiet. On Tuesday, we get UK GDP. Wednesday, the focus is on the Fed with the FOMC meeting. Thursday, we get GDP reports for the U.S., Spain, and Sweden. And Friday, we wrap up with GDP for Canada. Plus, Friday's the last trading day of the month, so it's the 31st, so we also get Chicago PMI and people starting to set up for the next week, which will be the first week of the month, bringing PMI, bringing employment, and all those other announcements. So lots going on this week, and so I just wanted to highlight now in the context of this U.S. dollar move, I thought I'd look at a few of the key currency markets. So let's start with cable. Here, cable's been a little bit choppy lately. We've seen it's primarily trading back and forth in a range here between about 152 and about 159. And in the middle, there's this Fibonacci level about 155.80, which it's bouncing around. More recently, we've seen it trade between about 155 even, and this up here is about 156.75. So we're primarily trending sideways on the pound. But if we get a strong UK GDP report, that could reignite speculation on when the Bank of England might start to raise interest rates. The party line has been the middle of 2016. However, with recent comments about concerns about rising inflation in the UK, some people have started to move that to suggest that that timetable could be moved up. I suspect the Bank of England will not move before the Fed, but anytime after the Fed starts raising interest rates, could be a clear runway for the Bank of England to follow suit and do the same. So we'll watch that. We're watching that. If we get a very weak GDP report, so a strong GDP report moves up the timetable for interest rate hikes. A weak GDP report could push it off, and so strong could move sterling up, weak could move sterling down. We'll also take a look here at US dollar CAD. Canada, of course, reports GDP also this week, which will be significant as well. And the reason for that is that we're coming off of the second Bank of Canada interest rate hike this year, and there's still a lot of concern going on about whether Canada's dropped into a recession or not, or if it's just in this very slow growth, bounce around zero kind of situation. We've had the negative impacts of the oil price crash hitting the oil patch first, and we haven't quite seen yet the positive impacts work its way through into the Canadian economy from the lower loonie. The loonie's come down dramatically over the last few months. That makes things good for manufactured in Canada, non-manufactured exports to the United States. It's better for tourism because Canadians stay home and the dollar makes it cheaper for Americans to come to Canada. Same with industries like film production. It's a lot cheaper to come back to Canada now, and also the cross-border shopping goes down. So there's a lot of reasons that over the longer term that as you get a rebalancing away from a dependence on energy back to a more balanced economy, that's a positive, but it doesn't seem like we're quite there yet. So the question is the Bank of Canada now done cutting interest rates or not? It was last month's GDP report was one of that came in weak. That was one of the first things that triggered on the move towards cutting interest rates once again. So Canada's GDP report could be quite significant, could spark quite a bit of action. Now, here's something interesting, and it shows us here. The US dollar is getting pretty overextended up here. We're up at 131. There's a measured objective around 132. And we are getting support, though, above 130. But if we look here, the RSI is getting quite overbought, suggesting it's due for a pause or correction. Now, to be fair, we haven't seen a negative divergence in a meaningful way, just a small one here. We haven't seen this roll back down yet. So far, the RSI is still confirming the uptrend, but it is getting overextended. So at some point, we could see a correction back in the loonie. And in this case, what could strengthen the loonie could be a stronger than expected GDP report. A weak GDP report would primarily just keep the pressure on the Bank of Canada to potentially cut interest rates further into the fall if they have to. I'm going to talk about Eurodollar as well. There are a few things circulating in Europe this week. In particular, there is we do get GDP for Spain, which could be quite significant heading into the fall, because Spain and Portugal have elections. The Spanish government really needs to start showing that they're turning around their economy, that their austerity measures have worked, and this is at a time, of course, when the country is running 22% unemployment. So they need some good news to say that their policies have been working. Otherwise, their policies have failed, just like they have with Greece. Greece negotiations are expected to resume this week as well for the next bailout package, which is supposed to include some sort of debt reduction as well. We'll see if we get it, but here heading into that, at this point, they haven't even been able to find a secure place in Athens to even have talks because people are so upset with all the things that have happened with the last round of negotiations. So that could again become contentious. On the interim, though, we do have the euro had tried to bounce recently. It's stalled out short of 110. What does that mean? It means it remains in this longer term downtrend, falling channel here. Lower highs, lower lows, and RSI topping out below 50 again, and that's in a downtrend, so downward momentum for the euro as well. So unless we get something really positive for the euro, or a weakening in the US dollar would also work. So far, this downtrend appears to remain intact. We've got first support for the euro here in and around 109.10. Then this one here, this Fibonacci level around 108.70, and these lows here in and around just above 108 even, 108 to 108.10. The other currency market I'll highlight here and just wanted to talk about a little bit was gold. Gold is coming off an absolutely awful week. We've had it under distribution for some time. We had this descending triangle forming here above 142 and the November low. Then this here was the 133, 135 was the November low. This 142 was the March low. The once it took that out, the bottom just literally fell right out of it. You had a completed technical pattern. You've taken out previous support levels, and gold was just absolutely crushed from about 1130 down to about 1070. It did bounce back and tried to build some support around 1100. That didn't really work, and we're seeing distribution resume. Gold has become extremely oversold on the RSI, but at this point in time, it does remain under pressure. I suspect we could actually get a little bit of a trading bounce in gold this week as it tries to stabilize in, say, an 1170. A 1070 to 1110 channel here, but so you may get a little bit of a boost in gold, and also if we get any weakness in the U.S. dollar off the Fed meeting, could also give gold a boost. So we'll be keeping an eye on that. But longer term, however, gold still remains in a pretty rough spot. I'm going to show a very long-term chart here of gold I wanted to highlight. This is the monthly chart for the last 17 years of the gold price. So it shows way back when here, if we start looking at the 2001 to 2011 bull market, that the price of gold has been drifting back, and as we can see here, it's exploded to the downside. This is a big bearish candle here now that's emerging on this monthly chart in gold with a big breakdown. But more importantly here, we have gold back in and around 1080, 1070, 1090 is testing this 50% retracement of the previous big bull market. If this holds, another reason to suggest we could see some support and maybe a bit of a trading bounce. If this fails, next support for gold is this 1,000 round number here, and the 62% retracement of the previous big bull market is in and around 890. So gold does look like it's breaking down. We may get some short-term support here in the near term, but over time, gold still looks vulnerable to the downside, particularly if the U.S. does start to move towards raising interest rates later this year, as the Fed keeps claiming they're going to do. While we're at with gold there, I'm going to close this out now. Next thing I wanted to talk about was to move into earnings season and earnings preview. We've had a number of stocks move quite significantly off of earnings reports. This week, there's a focus on two areas. One is on tech, the other one is on big oil. And I wanted to start with a discussion of the oil price here to show why the big oil earnings could be of particular interest to traders. This here shows the 12 months of the WTI price, which is in the candles, and so we had the big crash, stabilized. We had a trading bounce from this low 40s to low 60s. Now we've come back under 50. What's more significant about this is I want to show gasoline and heating oil. Heating oil, being a more seasonal commodity, tended to outperform through the fall and the winter, but this has been fading off into the summer, of course, because heating oil and natural gas as well, their seasonally favorable period is in the winter. Now gasoline, their seasonally favorable period is in the summer. Watch this. Last fall, right through October, November, December, January, gasoline pretty much tracked crude oil straight down. Since, however, January, gasoline has outperformed crude oil in a pretty major way. The spread has widened out dramatically, and this has really boosted the profit margins for refiners, for chemical companies, for anybody who's using crude oil as an input and did not decrease their output prices as fast. This also explains why we haven't seen an explosion in consumer spending, because even though crude oil came down, the price of gasoline has actually gone back up. So the effect you would have expected to see from lower gasoline prices putting money in people's pockets hasn't materialized because the gas price hasn't come down as much. Now, two things we're looking at here. The last quarter, we had a lot of huge positive surprises from the integrateds and from the refineries based on this a huge explosion in profit margins for those companies. This time around, will the street be taken by surprise, or has that already been factored in prices? That's the first question. And then, of course, as we start to move forward, could this spread start to narrow again? We are here in the middle of July. We're right in the heart hard in middle of North American Northern Hemisphere driving season. As we get towards the end of driving season and gasoline demand comes back off again, could we see this spread narrow out again? Is a good question and something we'll want to watch for as we move through earnings season for the energy companies. I'll just close that. And while I'm at it, I'll just highlight what's going on with crude oil prices here. We will look at West Texas. So West Texas here had a nice bounce up from about 42 to about 61.50. It leveled off over the better part of 6 weeks, and now it's back under distribution again. And look, it's taken out 50, it's taken out 49, 48. The Fibonacci retracement levels here, it's already taken out the 62% retracement. Usually if the 62 gets taken out, it's an indicator that you're most likely going to see a round trip right back to the retest the lows. Now, and 50 hasn't held up in any meaningful way. So even though crude oil is getting oversold on the RSI, maybe it bounces up into the 48, 50, 49 area, but it's in a pretty significant downtrend. We could see a short-term stabilizing like we did here early July, but basically this is still under distribution, and we could still see a retest of these lows in the low 40s sometime before the end of the year. I just wanted to highlight here on energy charts because we're looking. By the way, most of the reports for energy companies come out later in the week. We'll start here. We have Suncor Energy from Canada reports on Wednesday. On Thursday we get ConocoPhillips in the U.S. and in Canada we get Canadian Oil Sands and we get Cenovus. And on Friday is the huge day. ExxonMobil, Conoco, Phillips 66, Chevron, Imperial Oil, big oil, all reporting this week. Now, what intrigued me here was this. So this is what's going on between the integrateds, the producers, and the refiners. Because ConocoPhillips broke itself up a few years ago. So into a production company, ConocoPhillips, and a refiner, Phillips 66. And then I've compared this with ExxonMobil, which is still an integrated producer. Exxon has generally been quietly drifting lower throughout the year. However, it's interesting, ConocoPhillips, the producer, is down way more than the integrated. And on the other hand, look at this, Phillips 66, the refiner, has been trending higher since January, and the performance gap speaks for itself. This is just a huge difference in performance between the producers. Between the producers, the integrateds, and the refiners. Look at that. So at some point, do we see this reverse itself and start to close? But it's hard to say when we'll see that. But keep an eye on that spread there as we're going through the big oil earnings. I just wanted to highlight, finish up with 3 technology names to wrap up, and I'm going to start with Amazon. And then, which was the big surprise of the week that's ended, and then I'm going to go into. There we go. And then I'm just going to go into the potentially 2 of the bigger names reporting in the current week. So Amazon, much better than expected earnings, surprise profit, big explosion upward in the stock price. Now, it's getting pretty overbought again. Now, the last time it got way overbought like this was back at the end of January. It kept on going for a while and then it leveled off. So will it fall back and fill in this gap between 500 and 555? Hard to say, but it hasn't in the past. These previous gaps have not been filled. This breakaway gap here, this breakaway gap here, and so get breakaway gap in January, breakaway gap in April, breakaway gap in July, all following earnings reports. None have been filled in, so this thing still remains under pretty strong accumulation. Even though it's overbought, at this point we'd be looking at it more to go sideways than back down. The first of the 2 big tech reports this week. There's one potential positive, one potential negative. And it's Twitter and Facebook, and we'll watch and see over Tuesday and Wednesday how they do relative to each other. Tuesday brings Twitter, Wednesday brings Facebook. I'm actually going to start with Facebook. The Facebook chart here shows nice accumulation, was steady between October and May, and it's lifted off here in the last month or so, taking off to the upside. Breakout, consolidation, breakout, breakaway gap, consolidation at a higher level, all pretty good. RSI confirming the upward momentum, but RSI is getting pretty overbought here, and with the way that Facebook has moved up, expectations are starting to run high. So Facebook really has to deliver to maintain and to justify the share price. So on the balance of risks, the probability is leaning now more towards a negative surprise from Facebook, and that it needs a positive number to keep its party going. On the other hand, if we look at Twitter, is the opposite story at this point, because it's pretty depressed. Twitter had a breakaway gap on positive earnings, massive sell-off last quarter on the disappointing earnings, CEOs shake up and shoved out, and everything else, and companies struggling and spinning its wheels. Nobody knows what's well. Guess what? Twitter's back around its 52-week lows, and quietly over the last month or so, it's starting to creep higher a little bit. And look at this RSI from way oversold, positive divergence, and it's crept higher, and it's actually crept back above 50. So here's the question: we're in basically a trading channel, middle of a trading channel, 34 to 38, and then the next upside here around 39.65, a Fibonacci test there. So with Twitter though, expectations are very low at this point in time. Nobody's really thinking that they're going to show anything in the way of earnings. Plus, tough year-over-year comps, because last year in the second quarter was the World Cup, when tons of people were using Twitter to talk about football or soccer, depending on where you are. And this year we didn't have that. Although we did have the Women's World Cup, which was very exciting and great to watch, but not quite the same level as the Men's World Cup, unfortunately. All the same, then, so Twitter year-over-year comps, really tough hurdles, and certainly expectations are very low. So what does this set up for? A possible upside surprise. If we did get any kind of a positive surprise out of Twitter in any way, could give the stock a nice boost. So there's a lot of even though we're at the end of the month again, and there's a lot of events that are due that could spark quite a bit of trading across many markets around the world.